Hey everybody, Brian Stevens here with the National Real Estate Post. I have Dave Stevens here, the president of the Mortgage Bankers Association, and I reached out to Dave a couple of days ago, and the reason was because of a post that he put out on Facebook, and I look at this stuff quite a bit, and I couldn't really decipher exactly his conclusions with confidence, and this is about Brexit. Now Brexit, it's the flavor du jour, it's what everybody's talking about right now, and how it's going to impact the U.S. economy, really the global economy. And I got to tell you for myself, as I'm walking out the door every day and the birds are still singing, so I'm not seeing this catastrophic fall off a cliff that everybody's hearing about. It's not that I don't believe it's happening, or it could be an overreaction, whatever the case is. But as far as how it's going to impact the housing market and how it's going to affect your jobs and your consumers and your clients, we probably have one of the best people in the country who could really explain this to us in terms that we can understand. So with that, Dave, how are you doing today?
I'm good, Brian. How are you?
Good, good. Just real quickly, do you want to give an overview of Brexit? I have a feeling you're not terribly fond of the move that was made over in Great Britain. Can you explain a little bit about Brexit is, and then what your knee-jerk reaction was once the vote passed?
Yeah, I mean, very simply, it was a vote from the UK, Great Britain in particular, to exit their membership in the EU, the European Union. And I mean, that's it. There's a lot of aspects that are happening in the British political environment that actually in many ways mirror the United States. And people will talk about the concern about protecting borders and the inflow of escapees from Islamic countries and that kind of thing. But, at its core, the actual vote itself was to exit the European Union. And I don't think it's the end of the world either. And I walked out today and birds were chirping here too. But it's uncertainty that's driving the reaction in the markets. And I think that's what ultimately is affecting our market as well.
Okay, well, one of the first things I heard is how it's affecting our banks, not only banks in the United States, but overseas. We saw that Barclays was immediately down 21%, Royal Bank of Scotland 27%, Chase, Citi, Wells, Bank of America, Goldman. It's really across the board. In fact, I heard Jamie Dimon or somebody over at Chase speaking that they have 16,000 employees over in Great Britain, and they're going to have to move some of those to the mainland for changes that are taking place. How is that going to affect us over here in our mortgage market? And is it as bad as it's being portrayed to be with the banks?
Yeah, I mean, look, I'm going to go back to when you deal in financial markets, what the financial markets hate is uncertainty, and I think that's the word of the day. But let's just talk about what's happened. In the 5 days following the vote, the 10-year Treasury dropped 30 basis points in yield. That's a massive drop in interest rates at a time when we were actually expecting rates to start rising with a move from the Fed, which clearly won't happen in any near-term event. But in the last couple of days, obviously, at least from the equity standpoint, the stock market is recovering. We had a good run yesterday, and it's up about another 140 today so far. But let's just talk about what's literally happening. So first of all, 30 basis point rally in treasuries. It's created a fairly significant refinance opportunity. Anybody who has a loan originated prior to 2013 is in the money, we think, somewhere in that range. And it's forced us to revise our forecast. We came out with a new forecast just a few days ago in terms of loan volume. So rather than overall mortgage origination volume dropping year over year from 15 to 16, we actually now have a forecast showing that 2016 will have higher mortgage origination volume, almost entirely made up on what's going to be a refi rally. And Brian, and anybody, any lender talking right now, I've talked to several today, their pipelines are full. And that's one of the good signs. There are some awkward signs. So on the downside, there are losers to this move. The change in the currency cost has made the dollar really strong, and it's created a flight to quality. That's why investment capital is buying U.S. Treasuries. But at the same time, and that's driving rates lower, but at the same time, it's causing problems. So the dollar is more expensive, which means domestic real estate is more expensive for anybody outside the borders of the United States looking to buy real estate in the country. So for people in Great Britain in particularly, but anywhere in the European Union, the dollar has strengthened pretty significantly over their currencies. So real estate just got more expensive. So if you work in, Southwest Florida, where you have a lot of foreign borrowers coming in from Western Europe, that may slow a bit because it just made real estate more expensive for foreign borrowers. That's one negative. The other negative I would just highlight, and then I'll be quiet and we can talk further, Brian, based on whatever you want to discuss, is ultimately what this means generally for the purchase market going forward, and what it means to mortgage rates going forward. So on the mortgage rate side, there are two losers. Bond investors who bought mortgage-backed securities have now been impacted by a technical event that they didn't anticipate when they bought a duration match, and they're a net loser. And so we're already worried about liquidity in the mortgage markets. On the investor side, this is not a positive move. And likewise, mortgage servicing rights, and anybody who's focused on what we've been talking about with Ginnie Mae servicing, et cetera, that's going to create a higher prepayment speed on those securities and on that servicing book. And so they're net losers there. Will that impact liquidity? We don't know. And then on the purchase side of the aisle, it does shake borrower confidence, and it also lowers returns. You know, the shaking up of the stock market impacts wealth. And so, you know, earnings on retirement portfolios, et cetera, and people who have any nervousness about investing in real estate because of the worried about protecting their assets may get a little more concerned after the volatility we've seen over the past week. So the short answer is, you know, stronger dollar means flight to quality, good for refinance markets, good for those who had a pipeline and were just about to lock in their borrowers. I'm sure everybody's locking them in fiercely over the last couple of days. Negative for MSR buyers, negative for Ginnie Mae and MBS investors who buy securities, and could have some slight negative outcomes on the purchase side, but we have to see what happens over the next few weeks.
You know, I was reading an article. They said, well, we're waiting for the other shoe to drop, but the mortgage market and real estate is really, it's a centipede where there's a bunch of shoes that could drop. You know, we've heard that there was immediately $3 trillion lost in stock values, that we've seen Russian investors, real estate investors who were primarily investing in London are now looking at New York. We're seeing Asian investors, Chinese investors coming to the United States, investing in treasuries. Is this a short-term kind of booster shot for people looking at refinances, or is this something that's going to be long-term? Could the fact that we're seeing such a drop in stock values and a loss of wealth globally, could that not be a long-term problem that would come back to hit the United States?
Well, we've seen, as you know, Brian, we've seen significant market shifts in our lifetimes that have caused massive losses of wealth. Obviously, the most pronounced was the Great Recession, and what we saw during the greatest contraction in the stock market when it went down to 7,000-ish or whatever it ultimately bottomed out at. Our own view, and again, it's really difficult to hear anybody predict. I've been talking to our chief economist, Mike Fratantoni, about this issue, and the expectation is that this is likely fairly short-lived, and our view is while the Fed will not, for example, raise rates due to inflation concerns as soon as we expected, which would have been in the next, in the short term, we do still expect the Fed will raise interest rates probably in December. And so while it lowers our overall interest rate forecast, our trend line still is up for interest rates. And so that just reflects in general sense that we expect this to be relatively short-lived. But honestly, it's hard to tell, and anybody's trying to predict what will happen, what the pace of exit will be for the United Kingdom, or for Great Britain out of the EU, whether Scotland will take a different vote, and whether that creates some separation within the United Kingdom. And ultimately, what that pace of change is and what it ultimately means for any corporation that has an international footprint, those are things that are yet to be seen. Does this bring the Great Britain economy closer to recession? And does that have a global impact? Does that feed into the U.S. markets? All of those are things that you'll hear various economists making predictions on. And the one thing that I will say with absolute certainty, and for anybody in the mortgage business has to agree, anybody who's tried to predict the future has been wrong so far, because we've been predicting that inflation will drive interest rates up for several years now, and this is just another event that delayed that and actually created a rally instead of a correction. So, in that sense, I would just reiterate the fact that live a little bit in the present. If you're in the mortgage business, don't expect these rates to stay where they are. We expect rates to level off and then begin again. Some slow upward tick over time. This is a reaction to a technical event that was unexpected in the markets, and that's why you're seeing the flight to quality. If it turns out that Great Britain levels off quicker than anybody expects, then it isn't the end of the world, then that's going to actually reverse course, and the markets in Great Britain will rebuild, as well as the currency differential between the EU and the U.S. dollar. So all of that to be said is I'm short on economic forecasts at this point, but it is clear right now we do know what's actually happening. Rates are rallying. The dollar is strong, extraordinarily strong based on what happened. It has created a cost differential in U.S. goods versus foreign goods, particularly European goods. We're going to see some impact there. The only sure thing I can tell you is I had a friend telling me he's taking his family to London, and he had bought some currency a few weeks ago, and he asked me, should he sell it and buy new, and I told him to do that. So that's all I can tell you.
Okay, so we have a stronger dollar now, and that's obviously it's good for us. It's great for traveling like your friend. It's going to help us at the pump. It helps us buying things overseas. I did hear that Goldman Sachs, one of their economists, said that a 10% increase in the dollar is going to it's going to stun us 0.6% in economic growth. There is a concern that Britain isn't going to turn this thing around, which I think they're going to. They've got 2 years. They're already regretting this. They've got 24 months to wiggle their way out of this thing. But assuming that this thing does go on for a longer period of time, does this not then take the Fed as a defensive posture? Wouldn't the Fed then raise rates right now while the economy's doing so good to maybe slow down the dollar? And in the event that this thing goes on long term, it gives them some wiggle room to drop rates again if another recession is coming on.
Yeah, I don't think that'll be the trend line. And so two, one, who knows if they'll revote and reverse course. Prime Minister Cameron says that won't be the case, and we don't know. Goldman Sachs and everybody else is looking at the fact that U.S. goods just got more expensive. So as an exporter, the elasticity is going to negatively impact the U.S. economy. That's stuff that's highly likely. I have a really difficult time seeing an environment where the Fed's going to raise rates here in the near term. They're too stable. They're too focused on stability for the economy, and this is just again an uncertainty intervention that is going to, I think, force the Fed to slow down any decision making that could cause an additional disruption unnecessarily. And as we all looked at the recent GDP numbers from the U.S., we are growing, but we're growing very slowly. And so we've had our own concerns about how long the growth curve is going to continue even in the U.S. without this event. So, my own sense is the lean is going to be against a move, not for a move in the near term. But again, our chief economist, who's one of the best in the country, predicts that the Fed will still raise rates come December, which gives you his forecast that a lot of this will work its way through over the next several months. We'll have a good feeling about how stable or unstable, respectively, the various economies that are involved here are. But the U.S. growth path still seems pretty clear to be growing on a consistent basis, and that's why Mike still forecasts that the Fed will raise rates, because the U.S. economy is still relatively insulated from these events, and that the demand trend is still pretty strong here.
So the U.S. economy is fairly insulated right now. We noticed that the all U.S. banks passed their stress test just a couple of weeks ago. If that would have happened after this Brexit vote, would that outcome have been different?
I don't think this affects U.S. banks as much as it affects banks that are either domiciled in Great Britain or do a significant amount of business there. And so the reason is that the banks in Great Britain never got the bailout, as it were, that the U.S. banks did, and don't have the relative level of federal support that the United States banks do. They don't have a Fed window to borrow from, per se. And so there is a concern, obviously, about both capital and liquidity for the banking system over there. Not by any stretch my area of expertise, and I'd suggest people refer to other experts in that area. But, again, the U.S. banking system is actually pretty robust and pretty cash-rich right now. And so, from that context, I don't think any of us foresee some sort of adverse negative impact hitting the U.S. banking system. Jamie's comments, I think, were about his operations over there, but I don't think it was a commentary about the overall health or strength of J.P. Morgan.
We just saw that Boris Johnson, he tucked tail and ran. He was the one spearheading this whole Brexit movement and set up apparently to be prime minister. And he said, "Oh no, I don't want it. No, thanks, but no thanks," which I thought was kind of funny. I think this whole thing's going to lose a lot of steam. I have absolutely no reason to say that. It just feels that way from everything that I've read. And I know you don't like to predict things, and I promise I won't have a headline that says Dave Stevens states that blank, blank, blank will happen. But if you're looking at how this thing is kind of, if you're going to prognosticate, look through your crystal ball, in 12 months, what would your knee jerk? Again, I understand that it's a knee jerk, but what would your knee jerk with the U.S. housing market be as a result of this a year from now?
You've seen a couple of the articles I've posted, and there are smart people arguing that this will actually create a stronger Great Britain, and there are others that are saying that this is going to cause extraordinary weakness and push them into recession. And then there's this whole point about the number one most Googled item out of Great Britain after the vote was what is Brexit, and so or what is the EU. So it shows the lack of just understanding of what built their economy. I honestly think this will find its sort of leveling off pathway, and if it is truly a dramatic contraction, I think that's when you'll see the most momentum to change the vote and vote for a different outcome. They also have to negotiate to get out of the EU, and that's going to have a lot to do with mobility in Europe. Members of the EU can travel borders without having to go through an extensive and extraordinary visa process or approval process. People can live in one country and hold jobs in another. They can transition from country to country just as though you're transitioning from state to state in the United States. And if that becomes punitive, I think we'll see a backlash there. But in general terms, I think for all of us in the mortgage business, I think we're going to have a pretty good rally here in the short run. I do worry a bit about liquidity providers to servicing rights. I don't know if this adds another sort of negative motivation to get out of servicing, and that's something we want to avoid. But that's a side tangent. We don't really want to go down that rabbit hole right now. But I do think we should look close. I think for right now, anybody who's a loan rep who watches you guys is going to be, is dialing for dollars right now, and they're taking a lot of loan applications, and they feel pretty good. I would just emphasize that you can't overlook the investors in our business, and that's a really important aspect of this. And ultimately, this will pass and rates will rise, and it's just a matter of when.
Dave Stevens, thank you so much.